From the morning reading, the SPX breaks support and falls to 2097, rallies back to 2111, bearish below 2115. One of 10 sectors moved higher on Tuesday. XLE, XLF, and XLP were the strongest sectors, while XLRE was the weakest sector. Oil futures dropped 43 cents to close at 46.33, its lowest close since September 27th. Breadth weakened compared to the prior session as decliners led 22.92 to 7.44 on the New York Stock Exchange, and also decliners led 19.01 to 8.28 on the NASDAQ. On the S&P 500 snapshot, it's sell-off day 6, with Tuesday's major equity indices in Asia posting gains, but their Europe and U.S. counterparts finished the session uniformly in the red. The loss for the benchmark S&P 500 was its 6th consecutive decline, something that hasn't happened since August of last year. The index hit its 0.25% intraday high shortly after the open and sold off to its negative 1.33% mid-afternoon low, at which point a buy-the-dip strategy halved the loss to negative 0.68% at the close. About that buy-the-dip strategy, it was no doubt triggered by the S&P 500 dropping below the 2100 level, a situation that lasted for about 8 minutes. The 10-year closed the session at a 1.83%, down 1 basis point from the previous close. The S&P 500 breaks chart support as the VIX surges. Falling dollar pushes gold higher. The S&P 500 breaks support as the VIX surges. Election jitters are taking a toll on stocks. The chart shows the S&P 500 falling below its September-October lows to a 4-month low. All other major stock indices are falling as well. That leaves the SPX in position to retest its 200-day moving average. All 11 stock sectors are in the red, with the biggest losses on cyclicals, technology, industrials, utilities, and REITs. The CBO Volatility Index, the VIX, is jumping 15% as stocks fall. The chart shows the VIX reaching its October high around 20. A weaker dollar is pushing gold prices higher. Bond prices are also bouncing. Fear has made a comeback. After dropping below 13 barely a week ago, the VIX fear gauge rose above 20 intraday on Tuesday. Investors are always concerned about the possibility of moving to a higher volatility market, but when the VIX has gone below 20 to above 20 in a short period of time, it almost always reverted back to its prior range in lower volatility and higher stocks. The S&P 500 sunk to a multi-month low in November. Because stocks enjoy a favorable seasonal tailwind this time of year, multi-month lows in November are somewhat rare. When the index has bucked the trend, though, it has led to a multi-week rebound almost every time, and it has been occurring frequently during election years. Option traders are piling into protective puts. Trading activity in put options soared on Tuesday to one of the highest levels of this bull market. Over the past 6 years, when traders have so heavily favored puts over calls, stocks have had a strong tendency to rebound almost immediately. Everyone loves OJ. The optimism index on orange juice has slingshot from below 60 to above 80 in less than 2 weeks, and now at the highest point since July of 2011. That has typically led to an immediate decline in orange juice futures, or if it did rally over the next 1 to 2 weeks, the next month saw decline. The only exception to this was October 1991 when it went parabolic. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insight of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:05 a.m. Mountain Time, and I am recording this in preparation for the market day of November the 2nd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into the morning report. At the time of this cut, the activity on 4 broad market U.S. indices was all rotating around scratch. On the crude oil, though, big move, down 1.52% at the time of this cut. Euro up about 1/3%, as is the long bond. Gold is up about 3/4%. China down about 2/3%. Hong Kong down about 1.5%. Japan down about 1.75%. Germany down about 3/4%. United Kingdom down a little more than 1/4%. And macroeconomic reports for today in the United States of note, you have the ADP non-farm employment change, the kind of preview to our monthly employment report. You also have crude oil inventories, the weekly, and then the FOMC statement and the Fed funds rate. Now, certainly there's no significant probabilities around an increase in interest rates being telegraphed at this point, but it is possible that that could happen today, and if it did, that would be a severe shock to the market. Nobody's pricing that in. Now, in terms of an expectation for the next meeting, that certainly is very much on the table. That would be after the election. In terms of current market conditions, the short-term VIX continues to climb. It's almost a 23 at this point. Skew just below the warning threshold of 125. And the IV percentiles continue to climb and are pretty much near the middle of their annual ranges at this point after having spent weeks in the very, very lowest areas. The S&P now at a 52, the RUT at a 42, the NASDAQ at 43, the Dow at a 47. We did have, for all that price movement yesterday, on a close-to-close basis, we ended up with only one index with a standard deviation size move, and that was the Russell. And indeed, the Russell's been quite weak of late, as you can see. We've had 3 -1 standard deviation moves in the last 5 sessions. And the other sessions ended up with their end-of-the-day rallies erasing some of those extremes and ended up with something less than standard deviation size moves. In terms of the charts, let's go ahead and go there. And here's our S&P futures charts, and you see indeed a very, very important breakdown. So, we've been talking about the break of diagonal support and then the break of horizontal support on the Russell. Well, now the others have joined. And you have, with the action yesterday, big red candle, but you also have this significant wick off the bottom. So this is one of those situations where if you take a look at the position of all this, so as one of the morning authors mentioned, you undercut 2100 on the SPX for all of about 8 minutes. And that's clear sign that the bulls came in and defended that area. Once that undercut was in place, the bulls came in and pushed it back up to where? Right at where the prior swing low was. So it closed right in the prior support area. So you have to say that the bulls had enough power yesterday to be able to hold the line at the most important place. And thus far last night, we probed down again, and we're right back at the time of this recording, right back where yesterday's close was. So no change from yesterday's close. So a lot of indecision at this point. So bottom line here is that you've had a break of horizontal support. We have tested below. It was rejected thus far. But if we use our standing on the cliff analogy, when we went to level 2 in the hedge risk level status, we're talking about kind of standing out on the cliff, and there's that possibility that you might fall off the cliff. Well, yesterday, we did everything but fall off that cliff. We were sliding down the edge of the surface of that cliff and managed to grab a limb and climb back up to the edge of the cliff, but we're still sitting on the edge of the cliff, as it were, in that analogy. So this is a very perilous situation where we're recovering. We got our breath back. We're still holding on. We're still alive. But at the same time, we're still sitting on the edge of the cliff. So very, very perilous situation, and one in which both the bulls and the bears can point to something in their version of the story. And the Dow, we also didn't come quite as far in relative sense. So you've got this prior support area, and we turned around just before that, and this was probably a situation where the S&P was had more energy and momentum, was down, and then started to turn. And when that market started to turn, the Dow also started to turn. Also last night probed down, a little bit more weakness today. Right now you're down below yesterday's close. So again, significant break of support, not so much a break of horizontal support as you had with the S&P, but certainly this is quite perilous as well. And the NASDAQ, which has been the most bullish of the markets, you can see in relative terms, it's got a long way to go before it gets to its break of horizontal support. So you certainly have had the break of diagonal support in recent sessions. You have this after having been very bullish since July and up over the cloud, you now are back down into the cloud and have really degraded to a neutral status. Now that's still better than the condition of the S&P or even the Dow, but it certainly isn't the same NASDAQ bull that we had even a week or so ago. Of course, the Russell has been the weakest of them, and I drew a fib retracement on here, and you see where the action kind of found support yesterday was in the 50% fib retracement area. We made some reference to this earlier, several recordings ago, that if we do indeed break these horizontal supports, you might find support at some of these hidden levels, such as fib retracements, or indeed at prior swing levels. So right now, what we would look for is to see, does this area hold? Or if the market does start to fall, you might look at a target of the 618, about the 1150 area on the Russell futures as the next target area. If you get through that, we often see a bounce at that 618 to the 7.3 area. You kind of draw a rectangular box right in here. So 1150 about to 1140. You often will see a retracement stop about that point and then move forward. If that area doesn't hold, we almost certainly will go to the full 100% retracement, which is about 1075. So very, very ugly situation there, and frankly a situation where the folks on the Russell cliff, they've already fallen off the cliff, and they're just basically rolling down the side of that face. And let's take a look at other markets. Crude oil also having a significant breakdown from its horizontal support and has fallen down at least to the area of the 38 fib retracement and the top of the cloud. And you notice the candles are starting to get smaller, so the momentum and energy is starting to peter out a little bit, at least for the moment, on the crude oil futures. So I might expect a little bit of a relief bounce at this point in crude oil, but that will also be dependent on what's going on in other pieces of information that are going to come available. For example, today you have the weekly crude oil inventory report. That was one of the things we covered in the morning report. So that could absolutely influence it, as could the dollar. And you see the dollar has been breaking down, and that certainly is a big part of what's going on in crude oil as well as what's going on in gold. And gold, of course, has broken out of this sideways consolidation pattern, and we now have got 3 of the last 4 sessions, including last night's overnight. This is an incomplete session so far, but this certainly is building on this, and gold is clearly on a breakout. Now, it's moved through some of the moving average lines, but there's still other important areas for gold that's going to have to get through some significant resistance, but we'll continue to watch that. Now, it's coming up right now, up against this 1305 area. So we'll take a look at anything about 1300 to 1305. That gold could run into some overhead resistance and at least stall the current short-term pattern. We'll take a look and see if that target becomes realized. And then let's take a look at bonds. Bonds, of course, along with gold, has experienced something of a bounce up. So there's been some activity related to, kind of looking for safe havens. But at this point, both of them, while they're experiencing some safe haven push, and the dollar is also, moving in such a way that is supportive of certainly crude oil and its move. At the same time, you have to say that the amount of fear, while we did get a pop, it's certainly not some sort of just, absolutely a huge volatility spike. And these are relative terms, of course. How hot is hot? Well, we did get a significant spike, and you can see here that yesterday we did get up over 20 and then fall back. And we've now, closed above the 18 area, which is significant. We'll talk more about that in just a moment. And as one of the morning authors mentioned, you went from the 12 and change to, over 20 in just a few sessions. So that's certainly a significant increase in volatility. But what's different here is that it was kind of the slow motion move up each day, a little bit more than the other. And most of the time when we think of volatility pops, we think of something like this, where, one day you're, a 14 and 2 days later you're at a 21. That's a spike. And, here's a day with a big spike. So often we see volatility just with huge expansions in volatility, and we've had the VIX daily squeeze fire. But we've also managed to do all this without ever having a VIX spike in place. And the VIX spike, by definition, is a close over the prior close by at least 3 points or more difference. And yes, more fear premium, more premiums available. Definitely the elections influencing all this. At the same time, don't get too far out in front of this. While I've talked about the, kind of holding on to the edge of the cliff and so forth, thus far, this doesn't have the look of something that's likely to set up into some sort of humongous correction and, the end is here kind of scenario. So I'm not saying that we can't fall off the cliff, as it were, on the S&P, and I'm certainly not saying that, a 1975 size move isn't in the realm of possibility, but this certainly doesn't look like it's some sort of, 100-point drop in one day kind of move that's being set up. So I guess if we're going to have really, really bad weather, as it were, in the market, it doesn't look like it's, a Category 4 hurricane at this point. But it definitely looks like it could be a hurricane. So again, with the weather analogies, this is very serious at the very least. But don't get too aggressive with your bearish positions, I guess is what I'm saying, because this might not last very long. As soon as we get some resolution with the election results, which is, less than a week away from now, this thing could find itself all the way back to where it started from. That's kind of the feel of it thus far. Now, that being said, our current indicators are certainly showing a sea of red, and anybody who's been following these videos certainly should not be surprised at this continued deterioration. We've seen the warnings as we look across the various ways that we look at the market condition. These warnings have been in place, and they've been in place and increasing and the change in rate of change over a series of trading sessions. So we had absolutely insights into these coming deteriorating conditions, and none of this should be a surprise to regular followers at this point. The intermediate term phase opinion, market phase 5, the break of diagonal support. You now have the break of diagonal and horizontal support on the S&P. Also, in the three market timing signals, I almost expected to see this first one go to a further deterioration, but it did hold on. I suspect that was important that the bulls rallied and got this back up over 2100. But the first one from IBD is still in the uptrend under pressure status. GMI index, a 1 out of 6 and 0 out of 8. Sell signal in place since 10-12. Stock charts decision point did have an update yesterday, and one of the signals on the Dow did go to bearish. So what do you have now? Short term, neutral to bearish on all four. On the intermediate term, neutral to bearish on 3 of the 4. And on long term, all 4 with a neutral, in effect, signal with 2 opposing signals. So the consensus to the market timing signals at this point is decidedly weak, though not outright all bear. So I should be careful to not say that. Position sizing opinions still holding on to 50% and 75%. You know what? That's wrong. It's 50% on the one. The other one closed above 18, so that's dropped to 50% as well. So both position sizing models have dropped to 50%. In terms of the intermediate term market posture, you see the S&P has dropped to a 23.6. That's a strong bear. And anything below a 20 goes to a severely strong bear. As you see, the Russell's already there. NASDAQ's also joined, and this was the strongest bull, and you see it's deteriorated pretty quickly now, and it is just as weak as the S&P at this point, and could also go severely strong bear with another day of weakness. Dow also strong bear, though a little bit better position. So and all this is reinforced with the weak bear sentiment line, so things are not very good on the intermediate term market posture. Hedge warning status, we've changed today. We've gone to level 2 plus. Level 3 is crash warning, and you can see, we are just right on the edge of seeing a level 3. If conditions were to close significantly below the 2100, we would be in a crash warning status. So just kind of keep that in mind. If you see that price probing down there again, there'll probably be less bulls to defend the second time. Though, obviously you have to give the bulls credit. They have held thus far. In terms of strategy opinions, the VIX is now outside the acceptable window to initiate new positions for novice traders. And then also the hedge risk level at 2 plus would call for significant caution on any initiation of option income strategies. You're frankly probably at this point worried about managing the ones that you already have on. In terms of covered call strategies and put selling, conditions not acceptable to initiate new positions for novice traders. We've been there for a little bit. So again, none of this current condition in the market should be a surprise to regular followers of this video. In terms of specific warning areas, a sea of red here. Just about everything that can be in warning status is in warning status. Market in decline, sharp increase warning, volatility ratio warning. Has hit the excess level to the other side, so we have to start looking for the potential for reversals and the reduction of volatility at any time. I suspect that given the date of the election and its presence to our charts, that this volatility will remain elevated until we get past Tuesday night. In terms of VIX futures, we're now up over 18. The daily squeeze has fired. Distribution day count, again, increasing to an 8 on both the NASDAQ and the S&P. The VIX phase has been increasing. The 10-day expected move is not only above 40, it's above 60 at this point. In terms of the trend-based warnings, all 3 are still in place, and the New York Stock Exchange new high, new low, 669 yesterday, so way over the threshold to be in a warning status at 300. It's really at 2 times that. The intermarket risk aversion indicators, all 5 have flagged as risk off. In terms of sentiment, there's certainly some kind of extreme sentiments in that bonds and the stock short term are at 1 and 3, but fear and greed index probably at this point is the better model, and you see we now are in extreme fear on the sentiment index. So big change from just 1 week ago when we were dead neutral and now have fallen all the way down to 21. In terms of sector specific, you can see it was a sea of red yesterday with only energy as a sector eking out a positive day, and indeed there was some breadth to that. So there were a lot of stocks that were positive in the energy sector. But once you get outside of that, there were much fewer to look at in each of the other sectors that made a positive day. And indeed, even the defensives, telecom, consumer staples, utilities, real estate, all these got hammered yesterday. So there just wasn't, it wasn't just a rotation to, the more defensive areas, or a rotation to safe haven status. We saw gold and long bonds earlier. While they certainly had some holding power yesterday, it wasn't particularly dramatic, and that's one of the reasons why thus far, the tea leaves would be telling us that there's not a lot of really big fear in the market where people are moving their market money into safe havens. There's just been a little bit of indication of that, not a dramatic flow from these kinds of risk-on sectors or even defensive sectors into the even more safe haven status places like the dollar and gold and the long bonds. In terms of market postures by sector, you can see it's pretty much a sea of red across the short to intermediate terms, and there's nobody, even financials are no longer holding up in the face of this this movement to the weak side. Percent change yesterday, 1 day, 5 day, 1 month, 3 month. You really, if you've been holding through all this recent weakness, you don't have very much to show for yourself if you're a bull, with very few exceptions. Financials, you still got a little bit of profits, and technology, those were two sectors that we talked about quite a bit there for a long time. Those, still holding up on the 3-month returns, but really have given back the vast majority of it, since then. So we're up over 20-something minutes. This was a long video today. Very important set of information and conditions yesterday. So we're going to go ahead and hit the disclaimers as always. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here for the full set of disclosures. We'll see you back here tomorrow for the next session of the Falcon Global Market Preview. In the meantime, as we always say, whether it's hedge risk level 2+ or it's level 0 normal, it's all about managing that risk, and that is certainly in action right now. Good trading.